You just watched silver do something it almost never does. It didn't drift up. It didn't politely climb. It detonated through the $90 zone, then slammed lower so fast it made your screen feel broken, and then it snapped back like the drop never mattered. That wasn't the end of the move. That was the market revealing its true personality. And right now, one number is quietly taking over every serious trader's mind: $106. This is Jon AG, and you're watching The Currency Academy by Jon AG. And don't forget, subscribe to support the original work, and if you're part of the movement against copycats, comment Jon AG best so I can see you. Now listen closely, because what happened this week wasn't normal volatility. It was a stress test. It was the market grabbing weak hands by the throat, shaking them until they dropped their position, and then watching institutions scoop up the metal they just dumped in fear. The crowd saw a violent dip and thought, top is in. The smart money saw the same dip and thought, liquidity just arrived. Same candle. Two different realities. Here's the big question. Is silver about to launch into the next leg, or are we staring at a final blow-off that ends in tears? The answer is not in your emotions. It's in the structure. And in a moment, I'm going to show you the one behavior that separates a healthy continuation from a terminal spike. If you catch it early, you keep your profits. If you miss it, you become exit liquidity. First, let's get brutally clear on what actually happened. Silver compressed for months like a spring. Every pullback got bought, every breakout got tested, then the fuse lit. Once price punched above that psychological ceiling, momentum traders piled in, shorts panicked, and algorithms did what they always do. They chased strength. But silver is not a gentle market. Silver is a weapon. It is designed to punish certainty. It makes bulls feel invincible, then humbles them. It makes bears feel clever, then it rips their face off. When price ripped through $90, a new audience woke up. People who never cared about metals suddenly cared. People who laughed at hard money suddenly wanted exposure. That is not just demand. That is narrative. And narrative is rocket fuel, right up until it becomes a trap. So why are traders talking about $106 like it's a magnet? Because markets have memory. And when a market breaks out hard, it often reaches for measured targets that are mathematically obvious, psychologically irresistible, and perfectly timed to trigger maximum FOMO. There's a tool for that, and I know some of you hate hearing it. Fibonacci, not because it's mystical, not because the universe loves spirals, but because millions of traders, funds, and bots use the same measuring stick, and that creates self-fulfilling zones. Here's the map. Silver made a clear impulse. Then it formed a visible swing low. When you project the expansion of that impulse, the first major speed bump shows up around the golden ratio zone. That's the area where markets love to fake you out. They spike into it, they whip back, they punish late entries, and then they decide whether they have real fuel or just hype. This week, silver hit that zone, snapped down violently, and then buyers stepped back in and lifted it again. That is not how dead rallies behave. But the real prize is the next extension, the full measured move, the level that becomes the headline, the number everyone starts repeating at dinner tables and in group chats. That's the zone around 106. And the closer price gets, the louder the crowd gets. Because $106 is not just a price, it's a permission slip. It tells late money, it's safe now. It tells influencers, it's time to post. It tells the public, you're missing out. And the public always shows up at the most dangerous moment. Now, I need you to understand something that most people learn the hard way. The most dangerous moment in a bull market is not the dip, it's the victory lap. It's the moment right after the target gets hit, when everyone thinks the risk is gone. That's when leverage explodes. That's when late buyers chase. That's when the market has the most incentive to punish, because there's fresh liquidity sitting on the table. So let's talk about the volatility you felt in your gut. Those brutal intraday swings are not random. As price rises, exchanges hike margin requirements. They do it to protect the system. But what it really does is force out leverage traders at the worst possible time. A margin hike turns a confident bull into a forced seller. That forced selling prints those ugly red candles that look like a crash. And then the moment the leverage is flushed, the market becomes healthier, because the remaining holders are holding with cash, not hope. This is why you saw a dip that felt like the end of the world, and then a recovery that felt like the market was laughing at you. It wasn't laughing, it was cleansing. Let me say it the way it needs to be said. There are people who want you confused right now. They want you staring at the candle instead of the context. They want you to believe the whip was a signal that the trend is finished, because if they can make you sell, they can buy cheaper. That's the oldest trick in this market. Silver moves like a psycho, the crowd screams, and then they hand their position to someone calmer. Volatility is not the enemy. Volatility is the tool. And when silver spikes, the paper market and the real world market can drift apart. On a chart, you might see a dip. In the physical world, you might still see tight supply, stubborn premiums, and a sudden shortage of easy inventory. That divergence matters because it tells you whether the move is being driven by real demand or temporary leverage. If price drops, but the real world stays firm, the dip is often a paper flush. Now, let's talk about 3 traps that destroy people in a fast silver run. Trap 1 is the perfect pullback fantasy. You promise you'll buy on a dip. The dip arrives, you freeze, then it rips, you chase. That cycle is how patience turns into regret. Trap 2 is the sell the top ego trip. Tops don't ring a bell. They're messy. There are multiple spikes, fake outs, and emotional headlines. The antidote is scaling out, selling pieces into strength so you get paid while you're still thinking clearly. Trap 3 is the leverage will speed this up temptation. Leverage is how you turn a good trade into a forced liquidation. Silver doesn't need help being violent. If you're over-leveraged, the market will find you. The biggest candles exist for one reason: to force surrender. Don't be the surrender. So what does smart positioning look like here? It looks boring. It looks like you size the position so a 20% slap doesn't wreck your life. It looks like you decide your risk before you enter, not after. It looks like you pay yourself on the way up, and you keep a core in case the move turns into a monster. And here's the mental framework that keeps you sane. Split your mindset into 2 buckets. Bucket 1 is long-term conviction. That position is not for day-to-day drama. Bucket 2 is tactical exposure. That's what you trim, add, or reduce when structure changes. If you mix the buckets, you'll either overtrade your conviction or you'll invest through a collapse and call it discipline. Now, here's the cliffhanger. The market is about to show its hand. When silver kisses $106, don't stare at the number. Stare at the reaction. If we see giant wicks, broken support, and a bounce that fails, that's distribution wearing a party mask. If we see a controlled pause with higher lows and fast dip buying, that's strength loading the next shot. And if you want one simple tell, watch time. Real strength holds gains for days, not minutes. A blow-off can't sit still. It spikes, it collapses, it repeats. When time stops being your friend, the trend is changing right in front. Now, let's bring this down to earth with a simple scenario. Imagine you bought earlier. You're up big. Silver has become too large inside your portfolio. It's distorting your balance. So you do what disciplined investors do. You trim, you rebalance, you lock some profit. That's not bearish, that's mechanical. And mechanical people survive cycles. Emotional people become cautionary tales. But trimming creates a second effect. The people who sell too early often get emotionally dragged back in later, because when price keeps running after you sell, it doesn't just hurt your wallet, it attacks your identity. You start thinking, I was wrong. Then you start thinking, I need to fix it. And that's when you do the dumbest thing in markets. You chase. Picture this. Someone sells around $90 because it feels high. Then silver tags 97 Bauern. They get uncomfortable. Then it tags $102. Now they're annoyed. Then it tags $100. Now they're not thinking about structure. They're thinking about pain. They're thinking, I have to get back in. That is FOMO in its purest form. And FOMO is how rallies transition into blow-offs. So what happens after $106? There are 2 stories, and both are plausible. Story 1 is continuation through consolidation. Silver hits the target, cools off, builds a base, and then later pushes higher. In that world, $106 is not the end. It's an intermission. It's the market digesting gains, transferring coins from impatient hands into stubborn hands, and building the next launch pad. Story 2 is the classic silver trap. Silver hits the target, prints a euphoric spike, and then begins a brutal mean reversion. Not because the long-term case is dead, but because parabolic moves always correct. Always. And in silver, corrections are not polite. Silver has a history of giving back 50%, 60%, even 70% after major spikes. If you don't respect that, the market will educate you with your own money. Do the math with me. If silver hits $106 and then corrects 50%, that's $53. If it corrects 60%, that's around $42. That's not fantasy, that's arithmetic. That's why people who diamond hand everything often end up holding bags for years while the market goes quiet. And the most expensive thing you can pay in markets is not a loss. It's wasted time. Here's the skill most people never build, separating conviction from timing. You can believe in silver long-term and still manage risk short-term. You can keep a core position and still trim into strength. You can step aside when structure breaks and re-enter when structure repairs. That's not weakness. That's professionalism. Now I'm going to give you the one behavior you must watch as we approach $100. This is the difference between a controlled rally and a final blow-off. Watch how price reacts after it tags the level. If it hits $160 and then holds above the last major support with higher lows, that's constructive. That's the market refusing to give up ground. If it hits $106 and then starts breaking support levels with heavy selling and failed bounces, that is distribution. That is smart money exiting into your optimism. And here's the part most people miss. The post-target behavior matters more than the target itself. Targets are checkpoints. Structure is truth. Now, while the internet is hypnotized by silver's fireworks, gold is doing something quieter and more sinister. Gold doesn't usually whip 15% in a day. Gold moves like a glacier, slow, heavy, relentless. And when gold is trending higher alongside silver, it's a signal that money is nervous. It's a signal that confidence is leaking out of the system. Traders are watching a target zone for gold in the low 5,000s, around the $5,270 to $5,200 area. That might not sound dramatic compared to silver, but in gold terms, it's meaningful. Gold has its own warning label. In a real liquidity unwind, even gold can drop 25% to 35% quickly, not because it's worthless, but because forced selling hits everything when leverage breaks. This is why you can't treat metals like a fairy tale. They are not a straight line to riches. They are a battlefield. You win by respecting the battlefield. And then there's platinum, the metal most people forget until it starts screaming. Platinum already doubled last year, and it's setting up a potential measured target in the mid-3,600s if momentum confirms. In commodity phases, metals often move together, not in perfect sync, but in rotating waves. When one gets too hot, money spills into the next one. That rotation is where opportunity hides. But let me pull you back to the bigger ecosystem. Because silver is not moving in a vacuum. Stocks are still pushing. Equities still look bullish. And yet, the air feels thin. It feels frothy. It feels like one bad week could flip confidence into panic. And when that flip happens, correlations spike. Stocks fall, crypto falls, metals can fall too. And the one asset everyone suddenly respects is cash. Not because cash is brilliant, but because cash is optionality. Optionality is power when other people are forced sellers. So what do you do with all this? You stop chasing narratives and you start following structure. Price is the scoreboard. Not headlines, not hype, not the loudest voice on the internet. Price. If silver is running toward 106, I'm not here trying to call the top today. I'm watching the approach. Is it a clean climb or a manic vertical spike? I'm watching volatility. I'm watching volume. I'm watching how pullbacks behave. Because if the pullbacks remain shallow and buyers keep stepping in higher, that's strength. If the pullbacks deepen and bounces start failing, that's a warning. And I need to ask you two questions, and I want honest answers in the comments. First, if silver hits $106 and then drops 20% in a week, what do you do? Do you panic sell? Do you hold? Or do you buy more? Second, if you could hold only one metal for the next year, gold or silver, which one would you choose and why? Your answers reveal your psychology, and psychology is the real edge. Now, let's address the I missed it crowd, because I know you're here. Missing a move happens. The market doesn't send invitations. But what you do next determines whether you become a participant or exit liquidity. If you chase late because you're emotional, you're donating. If you wait for structure, you're building a plan. And a plan is what keeps you alive when silver decides to punish certainty again. Here's a rule that will save you money. Never enter a position without knowing where you're wrong. If you don't know where you're wrong, you don't have a trade. You have hope. And hope is not a strategy. Now I want to tighten the recap so you have the whole picture in your head. Silver broke above $90 with violent momentum. The market tested the extension zone, flushed leverage, and recovered. That recovery is a sign of demand, not death. The next major measured target sits around $106, and that level will act like a magnet because it's both mathematical and psychological. After that level, history says silver can either consolidate for another push, or it can top and correct brutally. Big silver spikes have done both. Your job is to be ready for either. Now for the cliffhanger. The move everyone is waiting for isn't the break above 100 hours, it's the reaction right after. Because that's where the market tells you its intention. That's where the rally either evolves into a new base, or the bull run quietly dies while everyone is still cheering. So here's what I want you to do. Watch the structure, watch support, watch how quickly dips get bought, watch whether the market holds higher lows, and most importantly, watch yourself. Because the market can't make you click buy or sell, your emotions do. If you found this breakdown useful, subscribe now because the next phase of this move will happen fast, and you don't want to hear about it after the window closes. And again, if you're here for the original work and you're done with copycats, comment Jon AG best so I can see you. The algorithm pays attention, and so do I. Silver is a stallion. Gold is a glacier. Platinum is the sleeper. Stocks are the crowd favorite. Until they're not. And the next time silver rips your stomach out with an intraday dip, remember, that dip might not be the end. It might be the invitation. Now tell me, are you riding this move all the way through $106? Are you trimming into the strength? Or are you waiting for the pullback that scares everyone else out?